Hey there, Tony Howard, moneytrainer.co.nz. Welcome again to Money Tuesday, where I get to share a money tip with you that you can either use, share, or you can just leave it if it doesn't really fit your circumstances. Now this week, I want to share a tip for getting the best results from a revolving credit account. If you have one and it just doesn't seem to be working or getting you out of debt faster like you thought it would, then this is going to be a good tip for you to listen to. So first though, let me explain why it doesn't work for most people. I'll put some numbers on the screen which will help. So let's assume your net monthly income is $10,000. Now the understanding is that if you put your income into your revolving credit account, it'll reduce your interest costs, and it does, so that's not the problem. Then the idea is to use your credit card for all of your expenses so that your money stays in your account as long as possible. So we're going to assume you're able to leave the whole $10,000 in for the entire month. We'll use that as an income amount today. And your interest rate is 4%, so this saves you $33 in interest. And here's why this doesn't work for so many people. $33 just isn't noticeable. You pay off your credit card balance and the revolving credit account goes back to its limit. And you keep repeating this process and you're making no real difference to reducing your debt faster. If you have a revolving credit account, have a look at your monthly balance over maybe the last 12 months and there's a high likelihood you'll notice it hasn't really changed. And if you're thinking of getting one, then do the sums. $33 a month times 300, now that's the number of months in a 25-year mortgage. That's only $9,900. So simply crediting your income and thinking it will get you mortgage free years earlier isn't really the answer. You know, for 95% of the population, getting a revolving credit account working for them only happens once they stop listening to the advice of a bank. So today I'm going to share with you one of the several solutions I share with clients I work with so that they get the results that they were looking for. So here we go. Step 1, have your income credited directly into your revolving credit account. Step 2, work out the following. I'll use some examples to help you. So mortgage payments will assume $3,000, insurance premiums will insure $650, and saving this goal will set $1,000. So that gives us a total of $4,650. Then we'll subtract this from your income. So $10,000 less 4,650 gives us 5,350. Now you simply transfer that into a separate bank account and you plan your monthly budget with that money. If you repeat this and stick to the plan over 6 months, as an example, it'll look something like this based on a $20,000 facility. Now the reason this method works is you can actively monitor your growing savings balance and you can see your reducing loan balance. Because you now have clarity on the progress that you're making, you will protect your savings and you'll only use this money if you really need to. You're going to actively focus on reducing your debt because you can actually see the impact that you're having on the balance every month by sticking to your plan with the money that you've set aside to live off each month. So I hope this has been helpful. I know it makes a huge difference with clients that I coach. And like I said, this is just one of the many solutions that can fix this issue and help you reduce your debt faster. So for other helpful tips and ideas, keep an eye out for future Money Tuesday tips, or you can head over to moneytrainer.co.nz. And like always, if you can't find the answer you're looking for, or you'd like a different solution than the one I've talked about today, well, hey, just reach out to me, schedule a call, and we'll find the right solution for you.